My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to make you a little money. My job, not just entertain, but to teach. So call me at 1-800-743-CBC. Tweet me at Jim Cramer. Maybe it won't be a cakewalk for the bulls after all. Today we got a number that didn't fit. A consumer price index reading that was actually a little too hot. If you're a bull here, you're betting on a soft landing, and that means you need two things to go right. First, we can't have hotter than expected inflation numbers that make the Fed more hawkish. And second, we can't have subpar corporate earnings. You got to have good earnings. You can't have subpar earnings. Today, we got the former, which is why the averages tumbled this morning, even as they rebounded toward the close. Dow will be finishing up just 15 points. S&P dipped 0.07%. Nasdaq ending flat on the day. Still, December's consumer price index was indeed worse than November's, which certainly doesn't help the argument that we desperately need the Fed to give us rate cuts. At the very least, I don't see how they can cut rates in March, which is somehow still the consensus expectation. Look, the economy is way too strong for that. Remember, the Uber bulls, and I don't mean bulls that take Uber, I mean the bulls who think the Fed's going to cut rates 6 times this year, they need to be let down easy. When they see a number, like a 3.4% inflation number, they get very skittish because it means their whole thesis could collapse, which is what I thought at one time when the Dow was down big. Now, we didn't have any earnings to speak of today, but tomorrow we're getting report cards from the major banks, and if they aren't special, if they don't wow us, I think we'll be 0 for 2. And that could crack the exterior of what's been a pretty darn good year so far. Oh, and also tomorrow, Mad Money's going to be in the end zone of bank earnings and of the playoffs. We'll be at the GEHA Arrowhead Stadium in Kansas City for a pigskin-focused version of Mad Money. You will not want to miss this. We'll be out there for when Mahomes and the defending Super Bowl champion Kansas City Chiefs host Tyreek Hill and the Miami Dolphins Saturday at 8 p.m. Eastern Time. Now, you can watch it on Peacock in what will be the NFL's first ever exclusively live-streamed playoff game. But back to today. Why am I so circumspect about this market? As I said last night, we've had such a good run since the year began, but it's been based on the same things over and over again. A decline in interest rates and positive pushes by research analysts. We still had plenty of positive notes out today, but they were almost entirely about the same old, that narrow group of tech stocks we always focus on. We didn't get the broadening out that I like so much, the one that we've had since November. We had more stocks decline than increase today, and that's less healthy than the action we've seen typically since the bottom in late October. Of course, the bulls won't roll over that easily. Too much momentum. Let me give you some examples of what worked higher, even as we all knew the story. First is Cramer fave Salesforce, after Baird put out a note urging people to buy the stock because CEO Mark Benioff's getting more and more focused on delivering better margins and higher profitability. The firm notes they didn't think that would be the case. My problem with this push, I've been saying the same thing over and over again, both here and to club members for months. But you know what? The stock rallied nearly 3% anyway.
House of pleasure.
We saw a couple of reports about how NVIDIA had a terrific CES, the old Consumer Electronics Show. Again, I have been saying that all week, right? The whole week. So I wouldn't have expected it would move the stock higher. But NVIDIA spent some time in the red today, but then it burst right back into the green, which almost seems like it's its rightful place, with the stock finishing up nearly $5. We got a note about a survey of chief investment officers that shows they believe Microsoft's got a huge lead when it comes to the adoption of AI. Really? I mean, again, old news. Yet the stock went higher anyway. There were oddities, too. We know that hot inflation number usually sends interest rates higher, but the hot CPI this morning did not cause the bond market to sell off. Yeah, bonds actually rallied. It did, however, send down the utility stocks, which normally trade like bond market alternatives. That's not supposed to happen. Hey, one of these is wrong. It's too early to tell which. The bank stocks acted like the utility stocks. Yeah, that's right. They were saying that higher interest rates are coming. They all sold down. However, remember that JP Morgan, Citigroup, Wells Fargo, and Bank of America all report tomorrow. So we won't have to wait long to get a much better understanding of the situation. Of course, I'll be in Kansas City giving you that stuff as well as maybe a little color in the game. Now, I want to make it clear that stocks were a bit of a sideshow this time today. Yeah, today was the day when the SEC technically approved a Bitcoin exchange-traded product. Notice I didn't say the SEC approved an ETF. as you might have heard that otherwise. The difference is key. This is a trust, not a product. It's a trust that issues shares, then holds Bitcoin. Unlike ETFs, these trusts own a commodity, not a security. That means investors in these non-exchange traded funds don't get the benefit of what's known as the Investment Company Act of 1940, or the 40 Act. And that protects shareholders from a conflict of interest by the issuers. That's not good. I think you want the most protection possible when you're investing in something like this. And you want it to be like an ETF, not an ETP. Might not matter to you now, but it sure would if it turns out that the exchange-traded product doesn't do what it's supposed to do with your money. I only care about this because so many people take that kind of protection for granted after the disastrous experience crypto traders have with the products that were offered by convicted fraud Sam Bankman-Fried. Believe me, that extra protection would have been worth it. I wish you'd gotten it. Usually you see a sell-off after the launch of a new product that involves a commodity like the trust. They represent themselves as gold securities issuers. Gold did a run-up into the approval of these trusts years ago. Yes, they, too, don't have that 40 Act protection. And then they fell down hard after the things started trading. Didn't happen this time. Bitcoin still went higher. My view. I think Bitcoin has a place in a portfolio. I'm not against it. However, many of the other crypto coins are too Wild West for me, and I'd be careful with them. Regulators cannot protect anyone from a coin that doesn't really seem to exist, and we've seen that happen way too many times. It's not what I like to see. I can't protect you either. I do think that the enthusiasm of Bitcoin is not something the Fed wants to see. The Fed has historically not liked speculation and views it as inflationary. It can create too much borrowing in order to capture potential gains. And you definitely don't want a stock market led by exchange-traded products. That's it. Given this was day one after the approval and the market was tame and the stock of Coinbase, the repository of a lot of cryptocurrency, opened up big, then did a U-turn, a gigantic U-turn, and subsequent dive, finishing down $10 or 6.7%. Well, I mean, I'd say things were calm. But at least some sort of sell the news action happened with Coinbase. The bottom line, the bulls didn't get the cool inflation number they wanted. Consider that strike one of a two-strike game, not to mix football metaphors with baseball. Tomorrow's earnings bring another pitch. If we get another swing and a miss, I don't think the average will be able to rebound like they did this afternoon. Let's take calls. Let's go to Dave in Florida. Dave.
Yeah, big booyah down from Jacksonville from a brand new club member. Listen, do you think it's possible that rapidly advancing AI developments might help drive Zscaler to profitability this year? Go Eagles.
The answer is yes. I happen to think that Zscaler, by the way, is very good company. And it's also been an up stock. I mean, this thing was at 84 in May. It's 228 now. And yet I think it's not done. Barbara in Connecticut. Barbara.
Hi, Jim. Booyah.
Booyah, Barbara. What's going on?
Nothing. I've watched your shows for years, first with my dad, Charlie, and now I've got my son, Charlie, watching it, so I'm dedicating my questions to the two Charlies in my life. My question's about the food and beverage industry.
Yes.
And consumer staples, specifically Pepsi and Coca-Cola. Pepsi, I think, has gone from 196 down to 166 or something like that, with a 15% drop or so. I mean, it's got a decent yield, but I just read that Carrefour, a French company.
Right. Well, I'll tell you, I'll say this to the two Charlies and you. PepsiCo's got Frito-Lay, and I think that that's going to be part of a GLP problem, but I think that Coca-Cola doesn't. I would prefer Coca-Cola to Pepsi right now. Greg in Kentucky. Greg.
Hey, Jim, long-time Mad Money viewer. How you doing?
I am doing well. How about you?
Not too bad. Question on a travel stock.
Sure.
Let's see. CEO states company results were strong across major metrics, booking strength with higher than expected pricing.
Right.
Should I start a position in CCL with spring and summer months?
No. If you want to own those, just own Royal Caribbean. Royal Caribbean's got the best balance sheet. Royal Caribbean is the way to play it, and there's just no two ways about it. That is the one you want to be in. George in Florida. George.
Hey, Jimmy, it's George from sunny Florida. Tell me, friend.
Good to have you on the show.
Cash-rich giant and Bitcoin-rich giant, Block Inc., ticker SQ.
All right. Now, look, this stock is what I call an up stock. Even though it's not making a lot of money in the last 12 months, I think the Square should be bought. I think the street's going to get behind Square real soon. At $67, it's going to look like a real bargain. Oh, we're not done. We're taking even more calls. We're going to go to Bill in Massachusetts. Bill.
Hello, Mr. Cramer. How are you today?
I am doing well. How about you?
Fantastic. I'm a club member. I'm having a great time doing my homework, just enjoying it like you wouldn't believe.
Thank you.
I trimmed up my positions in the Magnificent Seven, like you said, too, and I'm ready to get more.
All right.
I was noticing Disney was down a little bit. What do you think about picking up a little more Disney?
Okay, Disney has to improve Disney Plus, and they must talk about how the turn in ESPN and how much sports matters. And I also think, by the way, that Nelson Peltz has to be in there getting things hotter. Hey, a hot inflation number today was strike one for the Bulls, and we don't want a swing and a miss tomorrow in the bag sport, because I don't think the average will be able to hold up like they did today if we get that. On Mad Money tonight, the price of crude roared today, so I'm going off the charts with the help of Carly Garner to see where oil could be headed over the next few months. Then, between the JP Morgan Healthcare Conference and CES, it's a big week for conferences. But there's one under-the-radar meeting, the ICR Conference, that gives us a sense of a host of consumer-facing industries. I'll give you my top 5 takeaways. And sometimes there's more to the story than just the stock price. I sat down for a second-part interview with the CEO of Becton Dickinson to hear a little bit more about his fascinating path to becoming a visionary in the healthcare space. You won't want to miss it. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.